So classic buy days, they don't spend a lot of time near the low. There's a whole lot of energy that takes off when it finishes its Judas swing. It goes, bang, takes off. So you have to be positioned at that initial high of the day prior to the Judas swing. Anywhere from that high down, being long, is ideal. And be comfortable knowing that you probably will never see that range from the initial high being taken out to the Judas swing low. You'll never see that range that creates that ever traded to the rest of the day. So you don't have to have your stop loss at the low of the day. You can go back 3 PD arrays in that range and put your stop loss there and just let it go. Go do something else. Go do something stupid like play golf, tear up your back. Go do something that's fun like go fishing. Go take a nap. Go take your spouse out or your significant other. Go have lunch. Don't even look at your charts. Just let it go. And then come back 10 minutes to 3 and see how much of the range you now have under your trade and how many times that you may have done something silly and small little short-term little moves and never had the whole daily range. If you start trading that way, anywhere between 4 to 6 days a month, those are those types of scenarios. They're not an everyday instance, but 4 to 6 days out of a month, there are very easy classic buy days. And obviously, the other thing is said on the opposite spectrum, where you'll have 4 to 6 down days that are classic sell days, where you can hold for the whole daily range. Everything else other than that is days that you're going to have to be a trader that buys and sells intraday. Or you stick with the underlying narrative that constitutes your reasons for being a buyer or seller for classic buy days, because the monthly and the weekly chart indicates to you that it's likely to keep moving higher. Well, then you want to stick to being a buyer. And if the monthly and the weekly expected to go lower, you want to stick to being a short seller. And that way you won't ever miss those classic buy days when it's bullish or classic sell days when you're bearish. But if you don't have that in your analysis, you need to start implementing that, because that's why you're missing the big moves. That's why you're not on side most of the time, because you're not spending a little bit of time. It doesn't take very much time at all, like minutes, just minutes, looking at the monthly and the weekly and the daily to determine what the weekly range might be like this week. What could it reach for? What could it reach for prior to that target? So there's going to be a graduated degree of your best scenario, your best case scenario. It could go up to this level. Or a reasonable level would be 250 to 350 handles higher than where we settled the previous week. So if you're bullish, what PD array is in that range? If you just worked with that, you're going to be light years ahead of everybody else. And vice versa if you're bearish. So when that Judas swing occurs, what your mindset should be is, okay, if there is an algorithm, and if there is an entity out there that is collectively interested in trading with what it does and how it books price, how it makes price behave a certain way, because I've already said this many times before, if we had control with the sheer volume that as all of us traders come together, we could manipulate the price much, much more than what we see. And it doesn't happen. And they give you things like the circuit breaker rule. Oh, well, it seems like, it makes it sound like, oh, yeah. we have to stop the randomness of all you buying and selling. That's not what that is. That's not what's going on. But it sounds good, doesn't it? It sounds like they're controlling the wild stallions. We got to keep you guys from crashing the market. We got to keep you guys from sending it to the moon. It's not fair. Why wouldn't they want it to go to the moon? Think about that. How's that for an argument? Why would they ever want to slow down the market? Okay? Come on. The moon's not always up. Sometimes the moon's under. So, I'm having so much fun. But once the smart money traders buy near the low or at the low, they submit to time. They know that the algorithm is going to do what the algorithm does, which is now keep offering higher prices. And it matters not how many people come in and sell short. It's just going to keep offering higher prices. And as it goes throughout the day, you'll have small little intermediate term retracements, which is during the lunch hour. And what you'll look for on a classic buy day is the initial high of the day that drops right down from there to make the Judas swing low, which is the low of the daily candlestick forming. Any short-term high that's above that initial high of the day, the buy side was engineered at right before the Judas swing lower. There's going to be a higher swing low. The lunch hour will many times drop down to that, and it'll clear the stops, anyone that's trailed it there, and it won't return to the high of the Judas swing. But classic support resistance traders will think it's going to go there. It won't. And usually in between that initial high and the low that forms in a lunch hour retracement, there'll be some kind of a fair value gap that stays open, and that's a breakaway. That's a breakaway gap. So I'm fleshing out the entire daily range for you. And don't take my word for it. Go back and look at classic 5 days, and you'll see these things are there. And that can only be there because it's driven by an algorithm. That means it's running a script. It does these things. It's been coded, and it's astonishing. It's astonishing when you anticipate and you see it happening. And it's a weird feeling. It makes you feel like I shouldn't know this. Like I should not know this. Like it feels like a dream-like state. It feels like you're in a dream because what you're seeing happen, you anticipated it, and then you're seeing it. And then when you get good at anticipating it, then you can execute on it. And then what do you do with that? The whole field of dreams is in front of you then. You'll still have losing trades. You'll still get stopped out on days you think it's a classic buy day or a classic sell day, but that's okay. If you stick with this logic, it'll serve you well in your pursuit. Market making is not dealing. I have dealers in my mentorship. I have students that were quote-unquote market makers for a options desk at so-and-so brokerage, large institute. I'm not going to say their names, but you would know them unequivocally. You would know. Like these are big name industries, and they're large institutions. And since learning from me, a lot of them have come forward and they're like, listen, in confidence, I'm telling you this, so please don't say who I am or whatever, but this is the facts, okay? These same individuals had admitted that while they were being a dealer and their title was called market maker, they were a market maker at the, I have to be careful because if I say it, I've broke my promise to them. But let's just say at a specific options desk, okay, they are the market maker for that options desk, for that trading firm. And they admitted that they had no idea what price was going to do. But they were offering the mechanism of putting buyers and sellers together at that institute or that firm. That's not market making. You're dealing. You're dealing in a price feed that you don't control. Period. And that's not what I say or mean when I say a market maker. The price, and let's go back to a currency, okay? Because it makes it a whole lot easier to explain. Euro dollar. Okay, so the euro, when you're buying and selling euro, when the move's going up, that move up was not instigated or propelled by buyers. The transition from a old price level to now current market price that may be higher, the only thing that chart is indicating and recording is transactions that occurred while that price moved from one price to another. It doesn't even matter how many people would have bought Eurodollar. If it was going to go there because it's ran on an algorithm, it's going there. It doesn't matter how many lots were purchased because it's going to keep going up. And it knows that there's going to be buyers and sellers that come in at any given time because of just impulsiveness. And we're seeing that transaction. But what you've been told and been lied to about is that's what caused the market to go up there. Look at a commodity market. Okay? Look at a commodity market, and when you look at the volume of that market, and look at the price runs that occur there. You'll see price runs that have X amount of contracts that cause a rally up. And then it retraces down. And then there's another rally that happens later on. It's faster. It gets to a higher high faster, but it does it on very, very, very low volume. Why wouldn't it have at least the same amount of volume that the first leg did, if not more, because it moves faster? Because it's being offered by an algorithm. It's electronic trading. The pits don't exist like they used to. Before electronic trading, the pits would see the price scheme. What are they looking at? That board up there on the wall. That's their price. The price is not in their fucking hands. They're not controlling price. They're looking up right now. What's the price right now? And they're saying, okay, I will buy this. I will sell this. Where did that price come from? The market maker. They're in control. It used to be about 7 to 10 gentlemen that used to sit around. And they would book price. They would control price. That's the way it was. And that price would be given to the floor. And the floor does their transactions, and you have the all-floor people like you and I, speculators, John Q. Public. We would buy or sell based on our patterns or whatnot. And the only thing that's recording is our interest at that time. But the movement between one price point to the next is already predetermined. The highest high and the lowest low of the day is already predetermined. All you have to do is study volume, and you'll see that there's price runs that have very, very low volume, but they move larger. Why is that happening? Because the people that control price are constantly offering higher prices. If Michael Jordan, back in when he was really popular, if he would have introduced a new shoe through Nike, everybody would go crazy simply because they want to have that shoe. He was the Judas. How to separate fools from their money. Well, here you go, Michael Jordan. Let me buy something for $100+ that doesn't last that long, and it's pretty much garbage. But people were shooting people and stabbing people and stealing them off other people. They wanted them so bad because they didn't have the money to afford them. Everybody has their own form of Jordans in trading, their own little logic, the thing that makes them feel like they're a basketball player like Jordan. I'm a real good trader because I use GAN. I'm a real good trader because I use Elliott Wave. I'm a good trader because I do this and I do that. Okay, good for you. But you wearing those Jordans ain't making you a basketball player. You using these logics that you think are the reasons for the market going up and down. These indicators, these overbought, oversold indicators, that's not making the market go up. How many times have you seen an oversold indication that was bullish divergence too, and the market just kept going lower? Just kept going lower. Just kept on going lower. That was the wake-up call for me, because I was a perpetual bull when I first started. I only could want to be a buyer because it made sense to buy low, sell high. I could not grasp the idea of selling something I don't own and making money when it goes cheaper. It was an alien concept to me. I couldn't trust that. And I just focused on being a buyer. And there was many times where I was trying to be a buyer as a 20-year-old, not knowing what the hell I was doing. And everything technically, based on every retail thing you can imagine, said that it was going to go up from there. And there'd be this little tiny little move up. And I'd be, yeah, I'm on side now. And the only thing it did was take out a short-term little high, the run trailed buy stops, and then the fucking floor would fall out. And I'm in drawdown because I don't have a stop loss. I'm still just in drawdown, and I'm thinking, okay, well, it just needed to do that little bit of move. Now it's gonna go up, and the whole time I'm watching it go lower and lower and lower, and I'm like, finally, I gotta puke my guts up. There it is. Let me at least have $200 left in the account. Let me just have that. And if I would have held on to that, it would have took that and more. So that was my wake-up call that there's something else going on here. Like I gotta look deeper into what's going on behind price. And the algorithm is designed and coded in a way where it will capitalize on two primary things. Where there are pending orders, and it does not know how many orders are above or below the marketplace. It doesn't know that. It cannot worry about that because that's always a dynamic fluctuating value. Just like look at level 2 data. You'll see the orders there. There'll be a big block. There'll be a 500 block, a 300 block, sitting at a price level. And then as we get closer and closer and closer, that order won't be there anymore. It'll be less. Why? They lose interest. They lose the interest as it's getting closer to it. Why is that occurring? Because that's spoofing. But see, you're looking at it differently. You're looking at it through the lens of retail. Like, it's going to go there because there's a big number there. That's bullshit. That's how you get tricked. That's how you fall victim to that nonsense. These things that are trying to point to where orders are, all you have to do is look at a 1 minute, a 5 minute, a 15-minute time frame, and you'll see every liquidity pool that these little bubbles or these little things are showing you. You don't need to know a number. The number is that's the red herring. That's the Judas swing gimmick of that thing, that process of visualizing how many orders are there. Those orders are not all literal. They're not actually going to be there when price trades to it. They'll pull them, but they're using big, large institutions can place orders there to influence other traders to book price for that express purposes of tricking them, knowing full well that every transaction that takes place leading up to that level that never gets hit, other traders are going to look at the chart and say, oh, this is one of those fanny pack patterns. And the last time I traded it, I got more money for my fanny pack. Come on, man. Like, if you give it enough time, you can come up with a gimmick or an excuse to get into anything. But you have to strip it down to the very bare essentials. The markets go up for buy stops. They go up to reprice and or rebalance and inefficiency. That's it. It goes down for sell stops. Or it goes down to reprice to or rebalance an inefficiency below market price. That is it. If your patterns that you trade off of happen to agree and overlap in that instance, that's why your shit worked. It wasn't because of your harmonic pattern. It wasn't because of Elliott wave. It wasn't because of anything except for that's what it was going to do at that time. If you go through all of your losing trades, I promise you it will be a revelation. But most of you don't even give a shit. You haven't journaled anything, so you don't have the ability to go back and study what you did wrong. But the ones that have, go back and look at where your losing trades occurred. And then look at what I teach, and you're going to see mine standing in front of your trade. What I tell you the market's going to do and how it's going to behave and book, that's why your trade failed. And vice versa. Look at all your retail shit, and the times that it works, it's because it's in agreement with what I'm teaching. And I know damn well that's narcissistic, isn't it? That's arrogant as shit. You're damn right, because it's the truth. That is the truth. And when you stop paying attention to all these gimmicks and you stop being these team mentality, VWAP team, volume profile team, VSA, supply and demand, they're all bullshit. None of that stuff makes price go up and down. Zero. You're not going to tell me the tick of the entry to get in at, which is the highest of the candlestick. You're not going to get out the lows. You're not going to trade like me. You're not going to get like that. You ain't going to get like that. Not in any of that other Mickey Mouse shit. You're not going to. Because if any of you could have done it, you'd be doing it already. Why am I still out here barking and then nobody's coming forward and saying, here's the shit that beats your stuff? Shut the fuck up, Michael. It's still not happening. That's what's entertaining. Like, you would think, seriously, you would think. Come on. I want to fucking see it. But it ain't there. But they'll come in and they'll make little remarks to try to discourage you. Because they know they can't beat it. And they can't stand it in their own skin. Seeing that they can't beat it. They can't make an excuse for how I'm able to do it. So the easiest thing is, oh, you're a fraud. Oh, you're this and that. But how do you claim that? When I have transferred the information to students that now are using it too. And now, you said I would never live stream and trade. I'm doing it in front of you. With precision elements that you can't copy in anything else.